What if I told you that some Canadian landlords are still paying rental expenses using after-tax dollars while sitting on equity in their home that could potentially improve their cash flow, reduce taxes, and lower interest costs? That's exactly why today we're talking about rental cash damming Basics 101. Hi, I'm Erica V, mortgage agent, cash damming expert, and a landlord, but more importantly, someone who has been helping Canadians across the country use smarter mortgage strategies to keep their rentals longer, improve cash flow, and build long-term family wealth. And no, as usual, this is not one of those get-rich-quick internet hacks. This strategy has structure. It has rules, and if you do it wrong, CRA could absolutely have questions. So today we're going to cover the basics. What is rental cash damming? Why landlords are using it, how it works with the Smith Manoeuvre, who it may benefit, and why the mortgage setup matters more than people realize. Now, let's get into it. What is rental cash damming? Well, at its core, rental cash damming is a cash flow strategy and a debt conversion strategy. So instead of using your rental income or after-tax dollars to pay rental expenses like property taxes, condo fees, insurance, repairs, maintenance, maybe utilities, definitely interest costs, or any shortfalls, you can actually borrow those expenses from a line of credit that's attached to your principal residence. Now, here's the important part. You use the rental income towards your principal residence mortgage as a prepayment. Why, you ask? Well, because the rental income is your money. You can legally direct it wherever you want. Most landlords let the rent hit an account and then use it to pay the rental expenses directly. But with cash damming, you redirect the rental income to aggressively reduce your non-deductible mortgage debt first. Then you use the HELOC to pay the rental expenses. And because the borrowed HELOC funds are being used specifically for investment-related expenses tied to the rental property, the interest may become tax deductible. That's where the strategy starts changing the math. Now, most landlords are cash flow tight right now, especially in today's market. Higher interest rates, higher insurance, maintenance costs, just higher stress all around. And meanwhile, they're still paying many of the rental expenses or shortfalls using after-tax dollars. That's the expensive way to own real estate. Rental cash damming is often used by landlords who still have a mortgage on their principal residence, own at least one rental property. They may need some cash flow relief. They definitely want to reduce their taxes. They absolutely want to reduce the interest costs over time, and they want to accelerate the mortgage payoff of their principal residence. Now, it's especially useful for those who have a shortfall, especially if you're servicing that shortfall with your after-tax dollars. This can work independently, or it can become a powerful accelerator layered into the Smith Manoeuvre plan. So think of it like this. The Smith Manoeuvre focuses on converting non-deductible mortgage debt into tax-deductible investment debt. Rental cash damming can help accelerate that process because more money is getting redirected towards the primary mortgage and reducing the balance faster. This creates more available readvanceable room over time. More efficiency, definitely more leverage, and we love it because it's more strategy. Now let's use a simple example. Say you own a primary home with a readvanceable mortgage, one rental property, and you collect $3,000 a month in rental income. Your rental expense total about $2,000 a month. Now most people would simply use the rent to pay the rental bills. Instead, the $3,000 rental income gets applied directly to the primary mortgage. The $2,000 of rental expenses gets borrowed from the line of credit. Now your primary mortgage balance drops faster, your HELOC balance increases, but the HELOC interest may become tax deductible because the borrowed funds were used for an investment expense. Now imagine doing that month after month. That's where people start seeing improved cash flow, tax savings, faster mortgage reduction, better long-term wealth building. And no, that's not magic. It's math. Structured correctly. So who is this good for? This strategy is especially interesting for landlords with equity but tight monthly cash flow. Maybe they already have a readvanceable mortgage either on their rental property or their principal residence. It's great for investors that are already implementing the Smith Manoeuvre strategy. Anyone with a surplus of income and they want to accelerate wealth building, families wanting to hold rental portfolios long term, or maybe parents wanting to create a legacy of wealth through real estate. And honestly, a lot of Canadians don't even realize that they may already have part of the setup ready to go. I've had clients come into consultation saying, I thought I was stuck. Then we reviewed the mortgage structure, the equity position, rental setup, and cash flow, and suddenly there were options. Not magic options, strategic options. Big difference. Now let me say this very clearly. The strategy is simple over time, but simple does not mean careless. The biggest mistake people can make online is listening to random do-it-yourself finance content creators who leave out tracking requirements, proper loan segregation, the proper structure for your HELOC, readvanceable mortgage setup, CRA tracking rules, documentation practices, and tax reporting considerations. CRA cares about tracing, meaning can you clearly prove where the borrowed funds went? Because if someone mixes personal spending with investment borrowing, uses the wrong account, doesn't track transfers properly, or structures the mortgage incorrectly, that is where problems can happen. This is why working with professionals matters most, not because the strategy is impossible, but because structure matters. The right mortgage setup, the right tracking tools, the right tax professionals means the right implementation. That's what separates long-term strategy from an expensive mess. Rental cash damming is not about gaming the system. It's understanding that your mortgage can become a financial tool instead of a just debt payment you survive every single month. For the right person, this strategy can definitely improve cash flow, reduce your taxes, lower interest costs, accelerate mortgage payoff, and create long-term wealth opportunities. But it has to be personalized, because every mortgage, rental property, income structure, and tax situation is different. So if you want to see whether rental cash damming can work for you, book a strategy call. And if you found this video helpful, love it, subscribe, and share it with someone who needs to hear this right now. And in our next video, we're talking about how this strategy can also work for sole proprietors and self-employed Canadians. Catch the next one with Mortgage Free with Erica V.